Hello, all of you. Thank you so much that because of your wonderful response, Concept Classes CA Dipti Chheda's YouTube channel has touched up more than 150 videos have been uploaded, and for that I got the congratulations message from YouTube. But then that all the thanks is you, that you are getting all the concepts and you are enjoying watching this conceptual video. So here very quickly we begin with the third part of the logical magic of cost of capital part 3. If you're watching this directly, please don't do that. Go and watch the part 1 where I have explained you how do we get KD's value. In the second video, we have learned how do we get KP, cost of the preference shares. Today, it is cost of equity shares, how to get KE. And why do we combine all this when we calculate overall capital, right? So we'll discuss all this right now, okay? I'm sharing the screen with all of you. See, in the last class, we have completed this. Just for a brief revision, I am sharing with all of you KD's formula. Interest into 100 minus tax by net proceeds. And if the face value and the redemption value is not same, then you add average premium as your expenditure, divide by the redemption value. Now I'm saying like this, but I have shown you in detail what is redemption value, how to calculate average liability and all. Same formula for KP. Only thing is preference dividend, don't do 100 minus tax, because dividends are not allowed as business expenditure, right? And average premium and average liability, rest all is same. Now, when it is going to be cost of equity, equity shares, there's very beautiful logic behind equity shares formulas, and there are many formulas, but which one to use when you get a combined problem? For that, let us go to our notebook. I hope you all are managing these booster notes at one place, wherein I have given you all the formula, KD, KP, and now let us do it KE. Cost of equity. So what do you mean by the cost of equity? Now suppose if face value of one share is 100 rupees, let us say company is paying dividend 18%. 18%. So of 100, 18 is like 100 is equal to 18 is equal to 18%. Okay, 100. I hope you are getting. Dividend is 18% on the face value. Now, I am telling you that over 2-3 years, I hope you all know the share trading goes on in the secondary market, stock market. The market value of this share went up to 250. Are you all with me? Market value went up with 250. Now, suppose these are all the logics, how formula is made. Now, suppose additional, say additional one share you want to buy for this company. So then shares you need to buy it at the market value, 250 rupees if you want to purchase. And on this additional share also, dividend how much you will get? 18. So can I say 18 rupees income you are getting, 18 rupees income you are getting and on the share, on the face value. But how much money you have put to invest in one share? 250 rupees. This is nothing but K. Ma'am, formula kahan hai? Aayega. Exam mein we will write formula, but if you understand the logic, you can do it very fast. 18 divided by 250 into 100. So this comes to 7.2%. Dear shareholder, Don't be overwhelmed. Oh, 100 rupees if I put in FD, they are giving me 8% return. But if I put in company, oh, this company is giving me 18% return. Chalo, let us put it in the company. Arey, but company is giving you 18 rupees on the face value, 18%. Yeah. See, that's why we are studying this chapter, KD, KPK. Otherwise, you can say, ma'am, 18% is the cost of the equity shareholders. But 18% you are getting on face value. How much money you have put in the company? 250 to buy one share. And return, how much is coming? 80. So, you are getting 7.2% return. And earlier there was no tax. Now on dividend also you have to pay tax. FD पे भी tax है, dividend पे भी tax है. All the dividends are taxable now. So on FD, if you are getting 8% return, on KE you have to see 7.2 and not 18. Such a beautiful, logical, magical comparison. FD पे you are getting 8%. In the investment in shares, you're just getting 7.2%. Before tax or after tax, it will be same because on both 30% tax is there. So then which one is better? FD, right? So what is the formula for K? DPS0 they call it, or DPS1, whatever, dividend. Divide by the market price, MPS0, market price right now, into 100. DPS1, what is the dividend you are going to get in the future? 18%. What is the market value at which you have purchased the share? 250 into 100. So this is your K. Clear to all of you, right? DPS1, dividend by market price. Ma'am, why there is 100 minus tax? Because dividend is not allowed as business expense. So if you pay 18% dividend, 18% is your cost. But then you are getting 250 rupees to use from company's viewpoint or from shareholder's viewpoint. Shareholder, you're getting 18 rupees if you invest 250. So actually percentage return is not 18%. So many companies happily they say 50% dividend, MRF tires 50%. 50% is on 100, but MRF tires ki value 40,000, 60,000. So imagine the percentage of the dividend. So what's the formula for KE? DPS1 by MPS0. But we all know that apart from this, right now the market value is 250. But if I sell this, I may get 270. So this 20 rupees is also income. Dividend to milega. Dividend is the regular income on share. But when you redeem the share, you're also getting the capital gain income. So isn't that to be counted? That's why we have more than one formula for dividend. See, look at this formulas. Short notes are coming and these other points are important. If I start explain in a routine class, this chapter goes on for 8 to 10 classes, aram se. But I am trying to explain you dividend price approach, DPS1 by MPS0 into 100. Yes, and if there is some flotation cost, issue of shares cost, वो market value से minus हो जाएगा. Are you getting? So if I am giving 18 rupees dividend to my shareholder and my shareholder are giving me 250, but if the flotation cost is 10 rupees, issue cost and all, how much I am using? 240. That's why F is minus. Some people say, forget about dividend. Dividend is just distributed profit. What is important is earning. Earning per share is very important. Right or not? See, two companies may earn 100. Both the companies are good. But this company gives a lot of dividend. This company doesn't believe in dividend. Flowing back, pura profit form mein hi rehne do, reserves badao. So then earning factor pay if you take, EPS1 by MPS0. S0 is the market value now. Earning EPS1 means what you are going to earn in the next year. Now so it's over. Now so you got 18%. Next year, how much dividend you are expecting? Okay, there's a trend. Every year they give 10% extra dividend. So this year 18, next year 19.8%. That's why DPS1 and EPS1. Divide by MPS0. Dividend price growth approach is same formula. DPS1 by MPS0 into 100 and all same. Plus growth. Plus growth rate is the percentage which are added. Nothing given in the exam out of the 5 formulas I am teaching, you have to use this formula. Earning price approach, same. Earning divided by market price into 100 plus growth percentage. Growth percentage are directly added. If this is 18% DPS1 by MPS0 plus 2% growth rate, so 20%. And realized yield approach. I told you, you're getting dividend also, DPS1, and you are getting the market value difference also. That just now I told you, 270 minus 250. You purchased in 250, but you redeemed in. So, ye bhi 20 rupees income hai, and this 18 rupees income on the total. I'll solve the problem as if 18 rupees dividend I am giving you, 20 rupees is the capital gain you got, and you invested only 250 rupees. So what is the return you are getting? That is realized yield approach. And CAPM is a different logic. You have to understand with the help of the diagram. K is equal to RF and beta and risk-free return and all. That we'll do it separately. So like this different approaches say the answer is going to be different. Nothing given in the exam, you have to use dividend growth approach. DPS1 by MPS0 into 100 plus growth rate. Okay. So as we complete all this, one second. I had to be here only. Now, can we calculate what is going to be my overall cost of the capital? For that, I have given a very nice example in the beginning. Look at this. Suppose I have put 300 rupees in the business. Just look at the screen, nothing to write. This is just an example. 100 I have taken equity. 200 I have taken debt. Now, on equity, my cost is 10%. DPS1 by MPS0 and all. So, what is the cost of equity? 10%. What is the cost of debt or debentures? 10%, but then after tax, it is coming to 7%. Now, if I say I have got 300 rupees from market, what is my KO? What is my overall cost of capital? You can't take average. 10 plus 7 kar do, finish. I know that cost of equity is 10%, but I took only 100 rupees out of 300, only 1/3. So what is going to be my weighted KE? 10% into 1/3. Take a pause. Aram se karo. Why am I doing 10% into 1/3? Because I'm using only 1/3 part as equity. So equity's cost will affect only 1/3 proportion. I'm doing 1/3. You can do percentage also, 33%, 67% and so on. So what is my weighted cost of equity? 3.33. Now, even though my debentures cost is 7%, how much debentures I am using out of the total capital? 2/3. So what is the cost of debentures? 4.67%. And what is the total cost? 8%. Are you getting? Will you be able to score 10 out of 10? You make a table. Equity, debt, preference, loan, और भी आ सकते हैं. Preference is like KP, loan is like KL. So you write here and put the weights. Write the KE, KD. इसी के नीचे table बना के separately you calculate the KD, KP and all. Yes. Yeah. Then can you get the overall cost of capital? And just very quickly, like cost of bonds is the same like debentures, but KL is also there, no? KL. Sometimes the cost of the retained earning also they give. This also I want to explain. Cost of the retained earning, reserves. So what is the cost of the retained earning or KS? Many times 5 marks small formula is asked. KS is equal to K. Cost of reserves is equal to cost of equity. जो भी है. But when reserves are given to the shareholders in the form of dividend, they need to pay their personal tax also. So in exam, if personal tax are given 20%, then KS is equal to KE. KE to aa gaya. What is KE? 13.38 DPS1 by MP into 100 plus growth rate and all. But 20% you have paid the tax, no? So if you want to read, see, I gave you 13.38 rupees as dividend. On that 20% you paid tax. If you want to blow back this money in the form of reserves, how much you will be able to do? 80%. Are you getting? So what is KS? KS क्या है? KS is KE. Cost of the reserves, KS, is KE. But if personal tax are given, then KS is KE 100 minus personal tax, not company's tax. Nice explanation is also given in the routine class, and look at this format, super clear. One day before exam, if you revise your booster notes, if you revise this formats from this material, you will be able to solve. And if it is a routine class, we are going to take all the problems. Sometimes we take book value weight, sometimes we take market value, and there's also a concept of marginal cost of capital. So debt is after tax KD, KP, and equity, and multiply with this weights. So you get the KO. Got it or not? Agreed that my cost of debt is 10%, but I am using only 50%, so it's 5%. Cost of equity is 7%, but I am using only 30% preferentials, so 7 ka 30%. Like this, you calculate overall cost of capital, marginal cost of capital. If you sit with an aim to learn, these are the just concepts. But regular 6 to 8 classes along with practice of 2 hours each, you can complete this chapter till your exam. 100%. Beyond that, no problem will come. All the problems in the routine class are handpicked. Still, if you have any doubt, you can, all the links are shared below the video. You can connect with us, let us know. And if you really feel these videos 1, 2, and 3, these 3 videos for this chapter are really helpful to you, there is some value addition, then do share with your friends, do comment below, hit the like and notification button so that when I come up with the next concept, you get a message, right? Thank you so much. Thanks for watching the video till end. I hope you all have taken all the notes. Signing off now. CA Dipti Chheda here. Bye-bye. All the best.